It looks like Wall Street is picking up on the fact that home builders might actually have been oversold in this environment, and now is the time to pick up these stocks on the cheap. And could Warren Buffett be interested in one of the major home builders? That's what I'm going to cover in this video. So guys, smash that like button and let me run that intro. What's up guys, and welcome back to the channel. And my original thesis a year ago, if you've been following this channel for that far back, was largely the fact that I do believe that there's a secular growth characteristic for the home building segment because there's just so much pent-up demand because of the underbuilding that has occurred after the 2008-2009 recession. And there's just a lot of people who are looking to move into homes, and that demand needs to be serviced in one way or another. And so don't just take that from me. There's a lot of articles now being printed saying just that. So here's the Fannie Mae discussing that. And so you can see this is an article written by Jeffrey Hayward, the Executive Vice President and Chief Administrative Officer of Fannie Mae, as early as October 31st of 2022. And effectively what he's saying is that every American city has a housing supply problem, but each city's housing supply problem is unique. And I'm not going to go into the different reasons why there's a supply problem in each city. And what I will get into, and he gets into very directly here, is what has caused this undersupply of the housing market. You can see that the causes of the housing supply crisis are widely understood. After the Great Recession, they like to call the 2008-2009 recession a Great Recession. I don't think that's the Great Recession. But anyways, new home construction dropped like a stone. Fewer new homes were built in the 10 years ended 2018 than any decade since the 1960s. And by 2019, a good estimate of the shortage of housing units for sale or rent was approximately 3.8 million homes. And then the pandemic didn't make it easier. A lot of home builders took the summer off in 2021 because the price of lumber just soared. And so, of course, that exacerbated the underbuilding of the country. And so now we're in a situation where interest rates are high. We're entering into sort of like an environment where home buying might actually slow down in the short term. But what is the trend long term? The trend, of course, is that there's still going to be an underbuild. There's still going to be a huge demand for home builders to build new homes. And so if you are a long-term investor, I'm talking 5 years plus, this is an industry that you really got to consider investing in. And you guys know that I'm heavily invested in Alibaba, but going into fiscal year 2023, home builders will largely be the number one position in my portfolio. But like I always say, I don't expect a lot of people to agree with me, and I want you guys to write exactly why you disagree with me on home builders in the comments below. Look, at the end of the day, the whole point about being a value investor is you make your independent analysis and independent decisions. And in many situations like this one, you just kind of end up being alone in your thesis and the stocks that you're buying. But let's dive into the article that was recently released by Barron's. So you can see here, Barron's is actually getting a little bit bearish here. So they're saying the housing boom is over, but housing stocks could still be winners. And what they really mean here is that they are predicting exactly what I'm thinking, is that the current boom, like the short-term boom, may have in fact be over. And I think they're right. But I think what Wall Street is picking up on is the fact that these builders are still expected to operate in the black throughout the medium term, so which is going to be the downturn of the housing market. And overall, they could still be winners. And that's kind of what they're picking up on. And so, you know, I wrote it here to the side here in the red. A short-term housing boom may be over, and there may be a short-term slowdown, but the secular tailwind persists. And if you invest for the next 20 to 40 years, I would even say the next 5 to 40 years. It depends on, you know, yourself. I generally have a very long-term time horizon. I like to invest in sort of secular themes. And so that's why I generally have a 20, 30-year time horizon or 20, 40 years. And so you have to really take that perspective if you're going to move into this space, I think. And so here's what they're saying is happening overall in the industry. Right now, you have plunging orders, which we've absolutely seen. You have widespread price discounting, and you have shrinking profit margins. And that is all expected right now. But home building stocks are actually looking beyond the current gloominess. And in fact, they've actually gained an average of 20% from the June lows, though many of them are actually down 30% or more this year. And I'm going to show you a couple names that are down close to 50% this year. But it looks like Wall Street does expect that there's going to be more gains ahead, particularly if the much anticipated pivot by the Federal Reserve to a more accommodated monetary policy materializes in early 2023. Now, if I'm a betting man, I don't think it materializes into early 2023. I think a more accommodative monetary policy happens at the end of 2023, early 2024. Everything always happens slower than we think it's going to happen. And so if the Fed succeeds and slows the economy and inflation, a leadership group coming out of all of this is expected to be home builders, according to at least Bill Smead, who's the co-manager of the Smead Value Fund. So clearly, it looks like value investors are getting in on this right now. And value investors are generally early on these types of themes. But when you see these home builders start firing back up in their share prices, of course, you're going to see a lot of people following them into this. But I can't predict the future. Don't take anything that I say on this channel as a recommendation to buy a stock. I am an owner of particular home builders, and so I am biased as hell. And the article goes on to say that valuations are low. The group trades at an average of 8 times next year's projected earnings, and many of these companies are selling below book. Try and start a home builder below book and see how far that gets you. And so the industry is still expected to operate solidly in the black, and that's the most important thing here. I even don't mind if my home building stocks go into the negatives or the red a little bit, but overall, it just looks like it's not going to persist for a long time. Costs are coming down with the prices for lumber, and I do believe that just general layoffs as a whole will also push down wages as well, and so that will be another cost that I do expect to come down, or at least you're not going to have the boom level of wages where people were able to make a killing building homes. I think those 2021 type of wage rates are gone now. And of course, despite the pandemic hangover, as I've been saying on this channel, I would say at least for longer than a year. I think I started saying this in January of 2021, believe it or not. It looks like the long-term fundamentals are good, and I absolutely do believe that the long-term fundamentals are good. And so Smead actually says that home builders are just the kind of companies that Berkshire Hathaway would purchase. And so he believes that if Horton or Lennar call Buffett, and Horton and Lennar are the two largest home builders, they are Tract builders. If they called Warren Buffett, they could get a deal done in a few hours. Berkshire has exposure to housing through its Clayton Homes business and companies making paint and flooring. Now, I don't think Warren Buffett would want to own a Tract builder, although I could be wrong. I would think that Warren Buffett would want to like somewhat of a collection of spec builders as opposed to Tract builders, but I could be wrong. The other name that I do think that Warren Buffett would probably be more interested in would be like a Toll Brothers, because most of their, I would say like a fifth of their customers purchase their homes in cash, so they're not even interest rate sensitive. But that's sort of my theory on which home builder he would purchase. Now, Clayton Homes is the home builder that he owns. That's a modular home builder, so it's not the same business that, you know, these regular home builders are in. But I want to know what you guys think. Is Berkshire Hathaway the type of company that would be interested in acquiring the largest home builder in America, i.e. D.R. Horton or Lennar? You guys let me know in the comments below. Now, this article goes on and gives us a couple of options with respect to home builders to purchase. So investors who want to take the plunge do have many choices, and they want to start with D.R. Horton here. And so they favor D.R. Horton's because of its strength in entry-level homes, including its express segment, which sells houses for around $300,000 or less in many markets. But here's the problem with D.R. Horton. Although D.R. Horton can build homes cheaper than most other companies in the industry, the reason why they're able to do that is because they're what's called a tract builder. And what that means is they'll take a huge tract of land and build a whole subdivision on it. And so they make their money through sort of like economies of scale. And so that's why they're able to sell homes for much cheaper. But the problem is, if you have a very prolonged downturn, which we could foreseeably enter into, they're left with a lot of unsold inventory. Now, the fact that there's such a demand because there's such an underbuild probably helps them in this environment. But once again, these tract builders like D.R. Horton's and like Lennar do have an inventory risk in an environment where people may not necessarily be able to purchase homes, and then they're fire selling homes just to get them off their balance sheet. So that's why I don't like the tract builders. Now, the second builder that they recommend here is Toll Brothers. Toll sells its homes with an average price of around $1 million, and some 20% of Toll buyers pay cash. And so Toll Brothers buyers are less sensitive to interest rates and often are exiting homes with a lot of equity. And so I actually think that Toll Brothers would be a candidate for a Berkshire Hathaway. But the reason why I think a Toll Brothers is still a risk in this environment, because look, if people aren't buying homes in this environment because there's 7 or 8% interest rates for mortgages, then who are the existing homeowners that are moving up to a Toll Brothers home, selling their homes to? And so yes, they might be selling on a lot of equity, but that equity could also be deteriorating in a challenging home price environment. And so Toll Brothers also has a risk. And so I do like Toll Brothers. I like the business model, and over the long term, I do think Toll Brothers does very well. In fact, I think all these home builders do very well. I just want to highlight a risk that they did not mention in the article. Now, the last builder that they mention is Lennar. It's the number 2 home builder behind D.R. Horton, and it could be attractive as well as it plans to spin off its non-core businesses. And so here you have a type of a spin-off opportunity that I have to spend a little bit more time analyzing. And so they have a multi-family business and a single-family home rental business. And so I'd like to understand that a little bit more, but overall it looks like the company's trading at 1.1 times book value, so you can get the company for pretty cheap. So I'm going to do another video and I'm going to completely break down what the value proposition is in Lennar's spinoffs. I really enjoy spinoffs, by the way, but I got 3 other builders for you. In fact, really I got 2 other builders that I really like, and full disclosure guys, I'm invested in both of these guys. And so you can see this is the tracker that the Patreons get access to at the lower tier. And so you can see that under the column for ticker, the ticker symbols and the exchange which they're traded on is highlighted in blue. And the reason why it's highlighted in blue is because you can actually click into that and get into the models for each of these companies. And you can do this for all of the companies that I have on the tracker at that lower tier of the Patreons, which is just $5 a month. And so you can see here that Dreamfinders Homes, I feel as though they're trading at under 40% of their intrinsic value. So you can absolutely understand why I hold that one in my portfolio. And then the other one is LGI Homes. You can see that they're trading for under 70% of their intrinsic value. So it's not super cheap. I would like this name a little bit cheaper, but you are paying for quality with this name. Now, Tri Pointe Homes, this is a name that some of the Patreons like. My problem with Tri Pointe Homes is that they're overexposed to just one state. They have approximately half of their home building operations in California. They are trying to do the right thing and diversify out of California, but it is an existing risk for Tri Pointe Homes. I don't own that stock. So remember, guys, I did promise you that I was going to show you home builders that are down more than 30%. Well, you can see that Dreamfinders is actually down 47%, but because it's down 47%, you can see that a lot of the risk from the business has been taken out. And so effectively what you're seeing here is that the current valuation suggests an equity yield of approximately 20%. Now, if the EPS declines and this company's still operating in the black, but the EPS gets cut in half, you still have a 10% equity yielding business. And so what I'm really saying here is as stocks go down that are quality companies that operate with a solid business model and strong fundamentals and a strong balance sheet, little debt as it relates to non-construction loan debt, then it's a reasonable company to be allocating capital for. So I'm very happy to hope for a PE yield of somewhere in the 20% area. And I'm very okay with settling with a worst case scenario of a PE yield of in the 10% area. Now, of course, you guys know that the worst case scenario could be negative, but I just don't feel with an industry that has a secular tailwind and a company that's very nimble and they're operating in the right locations, because this company does operate in Florida and Texas and the Carolinas, etc. They operate exactly where people are going. I don't see a reason why this company won't excel in the future. Now, moving on to LGI Homes, you can see that LGI is down around 36%. Now, they are also a spec builder, meaning that they don't speculate on huge subdivisions, but they do build a couple of communities. And so once again, they're a little bit safer than the tract builders in this environment. And you can see when we go into the P&L for LGI Homes, they're expected to earn around a 13% PE yield, which is not bad, right? And this is good because they're actually, I would say, the best spec builder out there. And so from a risk-adjusted perspective, it's still a stock that I would like to hold in my portfolio. Now, of course, I would love to get LGI Homes cheaper than what they're currently trading at. And so I'm going to be looking for sort of like cash secured puts where I can potentially get this equity yield a much higher, but in the meantime, earn yield on the cash secured put as well. And of course, I'm just going to flat out buy Dreamfinder Homes shares. Like there's no point of using a cash secured put in that opportunity when the company's trading under 40% of its intrinsic value. It doesn't make sense. In fact, if you really wanted to and you got really aggressive, you could buy call options, but I just don't really like that speculation type of stuff. I'll just own the shares. Generally, you will do much better just owning shares. You don't have to play in the options game. You don't have to sell cash secured puts. You don't have to do any of that stuff. Just buy low, sell high is the easiest way to do well. But ultimately, as I always say on this channel, 95% of investors are probably better off just investing in indexes that track sort of like the S&P 500 or the Russell 1000, or here in Canada, the S&P TSX. Like you're probably better off doing that. And I would say just have a small part of your portfolio that's for individual stocks like this one. And so I do the same. I have my retirement accounts that I get through work in sort of like index type funds. And then, anything that I save on the side. In fact, I save a lot of money on the side. So I do deploy a lot of capital into the markets. But this portfolio, this equity portfolio that I manage on my own, despite it being extremely like a large amount of money, it could go to zero and it doesn't impact my retirement at all. So I want to make sure that you guys take the appropriate level of risk. Now, I recently put out a video where I talked about another 13% yielding company, and that's HP, and it's another company that has a relationship to Berkshire Hathaway. They actually own shares in the name. And so in order for you to get to that video, click right here.